Well, it's 7 o'clock, and I'm a big fan of starting on time to respect your time, and so we can get through all the content that we have planned for you tonight. Just to let you know, this is session two of a five-part series where I'm walking people through real estate as an investment, not just for people who use it as a business to invest and flip and continually buy, but to elevate people's thinking in terms of if you don't own your own home, that's your first step. If you own your own home, getting another home is your second step. So the last week we I'm going to give you. Let me just go here. Um, I'll summarize the last week's session, and after I go over the agenda, I just want to alert you to there in the control panel, you should be able to see there are handouts. So the slides from today are uploaded, so you can download those and have those. And then this recording and last week's recording will be on Stacy Loves Real Estate. That's my YouTube channel. The Tuesday night series is intended to be a longer format where the guest speaker has more time to speak and there's more time for Q&A. Tomorrow at 2, there's a half an hour session that is meant to be a quicker dive into this because people might be at work. And Mike will be with us tomorrow in case people want to stay on the phone longer and ask questions. And of course, everybody is welcome to set up a one-to-one with Mike or me to talk about your unique circumstances. Tonight, we're talking about financing options. Last time we talked about insurance. Tonight's going to be a little math heavy. And don't worry if you can't get everything. Please raise your hand or write a question in the comment box. Stop us at any time. This is meant to be interactive. And if you don't remember or get everything, obviously stop us, or we'll be happy to answer your questions one-to-one, because that's what we're here for. So the first thing we want to discuss is like why you're here, what interested you in this series, and why I'm interested in putting the series on. Then I'll summarize the session one and talk about the 3 strategies that my clients are using in order to build their real estate portfolio. Just so I make sure, yeah, you should be seeing the agenda on your screen. So ideally you see the agenda on your screen. And then Mike is going to talk about financing options. And then I will be giving a public service announcement to one of my favorite charities towards the end, Hosts for Hospitals. We'll review the series schedules, tell you what's coming up next. And then, of course, an open forum for any question, whether it's related to tonight's topic or not. And then all the contact information for all of the series speakers are at the end of this PowerPoint presentation. So I'm going to glance over to my control panel every once in a while. So if you have a question, raise your hand or type in the chat box, okay? All right. Okay, so just an overview. The first thing that we discussed in session one was my experience as a landlord. I've been in Philly for 20 years. I've been investing in Philadelphia real estate for 18 years. So I can tell you the good, the bad, and the ugly from my experience. And my experience has been nothing but amazing, with a few hiccups here and there that were all solvable. So the first session is really about just taking the fear out of becoming a landlord. Because with calculated choices and decisions, you can mitigate your risks. And also the strategy I use for picking properties. And then reasons why real estate, the benefits, the tax benefits, the equity buildup, the appreciation that you could earn, the cash flow and the leverage. When you buy a $100,000 property as an investment, you're only putting 20 or 25% down. If you own your own home, maybe you're putting as little as 3.5% down. Whereas if you want to control that much in stocks, you have to pay the whole thing and sell the asset in order to use the equity in it. So go back and listen to that webinar, the first one, for more details on that. And then Chris went into how to mitigate your risk with insurance. So there's a lot of information jam-packed in that first one. So I'm here and super passionate about real estate as an investment and spreading the word among people I know who rent and people who own their first home, because my clients are doing amazing things with their real estate. And in 15 years, having owned real estate over 18 years, I can see what the values have become. And while the past in Philadelphia, for example, has been 10% appreciation pretty much for the past 10, 20 years, those aren't my numbers, that's from the Center City District's numbers. Modest appreciation will still yield big dividends for you. And if you've got kids and you want to finance their college education, you can't save your way to $1 million. But with real estate investment, you can absolutely leverage that asset, the home that you own, and one rental property, and maybe another, into $1 million portfolio over 15 to 30 years. It just depends on where you're starting out from, and what the market does in the meantime. So I'm here just because I've seen what real estate has done for me, and I'm seeing my clients, 5, 10, 15 years in their homes and having kids. And I'm thinking, there's no way you're paying for college unless you invest. And so I just want to take the fear out of it and help people take the next step to become homeowners. So I'd like to know why you're here. So if you're at work, please come back to us. And I'd like to learn from you what you're looking to save for in the next 15 to 30 years. So I launched a poll. You can either pay for kids' college, fund your retirement, fund your lifestyle, or other. Maybe there's something that you're wanting to do that you're not sure about. All right, so we have our attendees. I will show you. So 1 in 3 of you is looking to fund your retirement, and 2 in 3 of you are looking to fund your lifestyle. And then I want to launch my second poll, which is how many people own currently and how many still rent and how many maybe own an investment property. So if you wouldn't mind answering that. So looks like, I don't know how these percentages worked out, but some more people joined us and answered the poll. Okay, so some of you still rent and some of you own your home plus 1 or more rentals. I know who that is. So yeah, so this is perfect. So the first thing you got to do is get your own home, and we're going to talk you through that, because you're going to be, I think these numbers are going to blow your mind as to what real estate can do for you. All right, so let's get to our next slide. Okay, so these next 3 strategies are ones that my clients, all of them are using, or all of them use 1 or more. The first one is for the renter. So if you don't yet own your own home, it's really important to start with that, because you can buy with as little as 3.5% down plus a few $1,000s out of pocket for closing costs. And I like to talk about the difference between being a renter and an owner over a 30-year period as the $1.2 million advantage. So what I did was I took a $1,000 monthly rental payment and I said, okay, let's assume you stayed in the same rental for 30 years. Not likely, but the chances are that your rent, you're probably going to increase your rent year after year. So I just projected a modest 3% increase every year. And over that 30 years, you will have paid your landlords $570,000. So 360 months, but you've paid them nearly double, $570,000 that went to pay their asset that is now appreciated. You will never, ever get that money back. Whereas if you became a homeowner and translated that into a $1,000 monthly principal and interest payment, and you had modest 4% appreciation. I had a closing today. This is a side note. And I was telling the new homeowner that about this $1.2 million advantage. And he's like, well, appreciation can't go on like it's been going on. I was like, exactly, because it's been 9 to 10% every year in Philly in the hot neighborhoods. It can't go on like that. But even at just 4%, which is an historical average, so 3 to 5% is an historical average, your house that's worth $200,000 today is going to be worth $648,000 in 30 years. So if you look at On the negative end, $570,000 that you paid to your landlord. And on the positive end, you own a $648,000 asset that you've paid down and has appreciated. You own it outright. You will have a $1.2 million advantage versus if you stayed as a renter. So, this is just the compound effect of compounding interest. And, sometimes people feel like because we've been in such a fast-paced appreciating market that there's no opportunity left. No, that is not true. Just buy something that makes sense. I can help you make a calculated decision. Something that makes sense today over 30 years can do wonders for your net worth. So I'd love to hear if anybody has any ahas or any feedback from hearing that, because when I stumbled upon, I've been doing this for a long time, and when I stumbled upon these numbers a year and a half ago, just doing this with a couple of colleagues, my mind was blown. So I hope, whether you say it or not, I hope your mind is blown. All right. And of course, stop me at any time if you have any questions. Now you may be thinking, well, 30 years, that's a long time away. Well, I broke it down over a 3-year period. So let's say you bought that $200,000 house. What does that look like versus a $1,000 monthly payment over 3 years? So at 3% interest or appreciation or inflation on your rent every year, that's $37,000 paid to your landlord over 3 years that you're never going to get back. And if we have 4% appreciation, you'll have earned $9,000 in that 3-year period. Actually, that might be, yeah, $9,000 per percent. No, that actually might be the 3%. Anyway, so I was being conservative there. And then the equity paid down is actually, I'm sorry, I switched these two. So the equity paid down is is 9,000, and the appreciation is almost 25,000. The numbers are right, the labels on these are wrong. So in essence, you would be down $37,000 if you stayed a renter in over 3 years, and you'd be up about $34,000 if you became a homeowner. So that net worth difference is over $71,000. So as you can see, in the near term and the long term, it really makes sense to get out of renting as soon as possible, so that you can start building, earning the appreciation and the equity build up, paying down your debt. And the best thing of all is that if you, in 15 years, after appreciation build up and equity build up, you will be able to leverage your asset. You'll be able to borrow against it again if you want to take out money to pay for a kid's college education, and you just ultimately pay yourself back. Or if you have a rental property, we would have your tenant pay it back, and the rent rates are probably going to be a lot higher then. So for example, rents that I started out, I think I earned like $1,100 on my first rental 18 years ago. Today, those rental rates are about $1,900, $2,000. So, my numbers are living proof that these numbers work. So if anybody has any questions, please feel free to stop me at any time. I want to make sure everybody, gets what I'm saying here. And if you have questions, I have time to answer it for you. All right. So now, if you're already a homeowner, which obviously most of you on the call are rent your home. So the first step is to own your home. And Mike's going to talk about those loan options. And then if you already own your home, 2 things that my clients are doing are either converting their current primary into their rental and buying a new primary. That one has that's a great advantage if, let's say, you've grown out of your original home. So for example, a client of mine recently bought a 3-story home with parking, about 2,000 square feet, roof deck, 3 bedrooms, 2.5 baths, basement, etc. So they moved into that because they were having their first baby. They then converted their 1-bedroom condo in Old City to a rental. So they were able to put down, I forget what they put down, but depending on the loan amounts, you could still put down as little as 3.5% if you're moving into the property, and then convert the current home into a rental. So I just wrote down some real quick things. So if, let's say, your current monthly payment is $1,200 and you rent it out for $1,500, That gives you a $300 cushion every month for maintenance and such. And for the new home, you could put 3 to 20% down plus about $2,000 out of pocket for inspections and appraisal. And you move into a new primary residence, and now you have two properties. So that does require at least a minimum amount out of pocket. And I'm going to talk to you about a home equity line of credit when we talk about financing options. So that might enable you to actually leverage that money as well. All right, so now the second strategy that my clients are using is what I call the split the equity strategy. Since we mostly have renters on the call, I'm not going to try to dive too deeply into this section because it is pretty money heavy or numbers heavy, but I can. So raise your hand if I skip over something and you have a question, or if you just have a question. So I have clients who, for example, my clients Dave and Bobby bought their first home about 15 years ago. They converted that into a rental, moved into their next home, and now they're working on getting a home equity line of credit from their current home, actually from their investment home, to buy a new rental. So they want to stay in their current home because they love it. It meets their lifestyle. It's a huge house and it's perfect for them. They don't want to move. So they're basically tapping into the equity in the current home to buy the new investment property. So what this looks like is, let's say their home number one, let's say they owe 180,000, but their new appraisal is 300,000, and they can borrow, let's say, $240,000 total. That leaves them $60,000 for the new purchase because they still have to. The lender is going to still consider the money you owe from your first loan on the property. So let's say the new monthly payment on that extra money that they borrowed is $360 a month. Now they go to buy the new home. So let's say it's a $200,000 house, 20% down is $40,000. The closing cost on that is about $14,000. So that uses up their $60,000. And their monthly principal, interest, taxes, and insurance on the new home is $1,134. And so their new total monthly payment is $1,434 or $1,494 a month. And then the property would need to rent for $1,500 or more to cover the entire payment. So usually when you buy, you want to buy for cash flow. And that assumes that you have cash that you're putting into the property. This is what I call a forced savings plan, because if you don't have the cash to invest, you're not going to save fast enough to outpace this strategy. So the lender will talk to you about making sure that your income, more than covers all of the new debt that you're taking out. But if you even break even on what you take in as rent and what you put out, as you can see on the right-hand side, you'd have to save $4,500 a month to outpace this plan in order to net, to own two assets in 30 years at 4% appreciation that net $1.6 million. So like Grant Cardone says, you can't save your way to $1 million. It's just by the amazing, miracle that is compound interest, that when you control the asset, your tenants are paying down the debt that you owe. The market's taking care of appreciation, which is historically 3 to 5% every year. And this is just based on 4%. And, rental rates rise, over time. Your purchasing power rises over time. So, you can't, I don't know. If you have a strategy that beats this, I'd love to hear it. Dave Ramsey is also a great resource, financial guru. He says, if you don't understand something, don't invest in it. This to me is easy to understand, and I'd be happy to make it easy for you to understand. What I don't understand is complex Wall Street stuff. So if you have any questions about what I've just presented here, like I said, please raise your hand. I know we have some more people that joined us. Please raise your hand at any time to let me know that you have questions. All right. So, that might be a little nitty gritty, lots of math, but the buying process can be broken down into 6 major components. One is determine your purchasing power. So from an investment perspective, we just need to figure out, what do you owe in your current property? How could you leverage your current property? Or do you have other assets for the new purchase? And then we can figure out what you can afford to buy. Then from there, we'll identify property types and areas that fit your budget and your overall, investment goals. Like, for example, I like to say you should pick an area where you feel comfortable to pick up the rent if you had to. Because unlike, maybe stocks, which are very intangible and impersonal, there's something very personable and personal and tangible about real estate. So we would want to make sure that, you'd pick the areas and the property types, whether it's a single family, duplex. Most of my properties are single families. I love single families, in an area where I know I have a good renter pool. So number one, determine your purchasing power. Number two, identify property types and areas that fit your budget and your needs. Then we visit and analyze those properties to make sure the numbers work. We make an offer. You do your inspection contingencies, and we go to closing, and then we lease out whichever property you're going to rent out, whether it's the new property or the current property that you buy or you already own. For a renter, the process is not that different. We're going to, together with Mike, you figure out your purchasing power, determine where you want to live based on your purchasing powers, and we visit and we make sure the properties meet your financial needs, make an offer, do inspections, apply for your mortgage, and then you move into the property. We don't obviously have to lease it out in that case. So I'd be happy to run through anybody's personal scenario. So what you do is you email Stacy@phillyliving.com and email me if you own your primary address that you'd like me to run the numbers on. So you'd have to have enough equity in it to leave equity in the property and also to borrow new equity. How much you owe, what your monthly payment is, your pity payment, principal, interest, taxes, insurance, mortgage insurance, or if you're a renter, just send me your monthly rental payment, and the amount of cash or other assets you have for the purchase. So if you're a renter, I really just need your rental or your monthly payment goal and your assets. And if you already own a home and want to use that, send me the primary, what you already owe, your current monthly payment, and any other assets you may have. And I'll run the numbers, I'll crunch the numbers, and I'll even pick out some rental properties that would fit your budget just to show you that it's possible. All right, so that was a lot. We just covered the renter to owner strategy, where you get the $1.2 million advantage when you own versus rent. And then we just covered the move up buyer strategy. If you already own your home, you convert your current owned home into a rental and you buy your new primary. And the third strategy was, if you want to stay in the home that you own and have enough equity or assets, you can basically leverage your own home and buy a new investment property that you rent out. So I'm going to pause here because we're about to transition into the mortgage section. What are your questions? And let me just see, unmute. I'm going to unmute you all. I guess mute yourself if you feel like you're in a loud spot. If you want to rate, I think, yeah, go to questions pane. I'm new to GoToWebinar, but I really love it. Does anybody have any questions? All right, I will keep moving and feel free to ask your questions at any time. All right, so Mike Gliatone from Center City Mortgage and Investments is Keller Williams Realty in-house lender. And what I love about that is if he does not do a good job for you, I will be down his back like a bulldog, making sure that he does a good job for you. So because he wants me to continually refer him business, he's going to do a great job for my clients. Based on my experiences with him, he is super sharp, resourceful, is easy to talk to, and answers your questions really well. So I highly encourage you after today, give him a call, talk about your scenario. Even if you're thinking, I'm a renter and I need to rent for another year, I have a lease that's good through 9 or 12 months, it's a good idea to get a benchmark of where you're at today, and set a strategy in place, because sometimes you need less money than you think you do, or your credit is not where it should be to get you the best rates, and position you the best. So now is the time. It's like the Chinese proverb, the best time to plant a tree was 20 years ago. The next best time is today. And as I like to tell my clients who have 3-year-old kids, today is 20 years ago for your kid to go to college. If you're 30 and you're retiring in 35 years, today is that 20 years ago in that proverb. So do take action now rather than wait. And we're always, we always welcome to have conversations, even if it seems premature to you. I guarantee you will get a lot out of it, and it will not be premature. So as far as closing costs, I'm just going to quickly run through some closing costs considerations in Philly. I'm going to go over a couple of items from Univest, the home equity line of one of the home equity lines of credit banks that I recommend. And then then Mike will take it over. He'll talk about renter to owner mortgage options, investment loan options, renovation loan options, and keeping up your credit. So just real quick, in Philadelphia, if you're buying a $100,000 house, your closing costs are going to be about $9,600. If you're buying a $500,000 house, your closing costs are going to be about $27,000. When you're an investor, you can only get a 2% seller assist, meaning you can only ask the seller to pay for up to 2% of the closing, or 2% of the purchase price, for your closing costs, to bring what you owe at the table to be less. So for example, if you got a 2% assist on the $100,000 purchase, you're in essence asking the seller to pay $2,000 of your $9,600 closing cost bill at closing. So you'd need $7,600 at closing plus your down payment. If you are buying a home to live in, many loan options allow up to 6%. So that means that you can finance, essentially, a seller assist is financing your closing costs over 30 years with a loan. So the way I like to think of it is this way. If, let's say, you had $10,000 in closing costs, and that costs you $50 a month to finance, and the seller said, yeah, I'll pay for $10,000 of your closing costs, which in essence is you borrowing it and paying it back over 30 years, I'd rather keep $10,000 in my bank account and pay $50 a month for that. So that's a great way to keep more cash in your pocket. Or if you don't have it, it helps you get into a home with maybe better loan terms, or a more expensive home than you could otherwise afford, because it's pretty cheap to borrow money. So yeah, so investors, you're limited to getting a 2% seller assist. Borrowers who are living in the homes can get up to 6% in many cases, and you want to talk to Mike about that based on your loan option. Let's see. All right, so a home equity line of credit is basically a second loan you're taking out on your property, or it could be the first loan, but it's like a checking account. So basically, you are, let's say you say, I'd like to borrow $100,000, from this property, and you close on this loan. You're not actually taking the $100,000 out right away. It's just available to you to draw it down. So you could write a $20,000 check one day, you could write a $30,000 check the next day, and then you just start to repay it. So essentially, when you're borrowing against your primary home, the maximum loan to value, LTV, loan to value, is 85%. So let's say your home is appraised for $100,000, and so the maximum loan to value would be $85,000, would be the maximum that the bank wants to see you owe. So let's say you already owe $50,000 on your mortgage. That means you could borrow an additional $35,000, because the bank wants to see that you have at least $15,000 equity in that $100,000 home, with $50,000 going to your primary mortgage and $35,000 being the new home equity line of credit. When you are borrowing against an investment property, and that's why I have clients that like Univest, you could actually take a HELOC out on your investment property, and you see down here, it's a 75% loan to value, or $100,000, whichever is less. So in that same scenario, if it's a $100,000 investment property and you already owe $50,000 on it, you can only take out $25,000 additional on the home equity line of credit. So together with Mike, the first conversation you should have though is with Mike to see if a cash out refinance makes sense, where you're basically refinancing your entire loan that you already owe, or if it's better to keep that in place and put a home equity line of credit. I just want to give you some basic parameters so that way you're familiar with what this is. So there are a couple key differences between a home equity line of credit and a primary mortgage. It's amortized over 20 years versus 30 years, meaning that instead of stretching out the payments over 30 years, they're condensed into 20. So that means the monthly payment will be higher over because you'll have repaid it in 20 years. And there are interest only and principal and interest repayment options. So if you, let's say you borrowed $100,000 and in 30 years, $100,000 owed is not going to make a lick of difference because your asset's going to be worth $325,000. So maybe you're like, I'll pay interest only and I'll still owe the $100,000 after 30 years and I'm okay with it. Then that monthly payment, when you're only paying interest, might feel just like something amortized over 30 years. And again, I apologize if this is going too into the weeds, but maybe this is exactly what you're looking for, or if it's too much and you have questions, we can definitely, raise your hand and we can talk later. One-to-one, and I can slow down and make sure you get everything that you need to get, and we could talk about your specific scenario. What else? So interest rates on your home equity lines of credit will be higher, but the amounts are so small that you're not really going to feel it. And the HELOCs take about 3 to 6 weeks from start to finish. So the one thing that I always encourage people who own their home, get it started now, put it in place, because you can start drawing on it. And, whenever you find that right property to invest in, you'll be ready to go. And you can draw on it up to 10 years after opening it. So it gives you plenty of time to start using it. So it's never premature to open up that HELOC. All right. Okay. So it is Mike's turn to talk. And again, I'm going to encourage you to raise your hand if you have any questions at any point. And Mike, are you there? Can I hear you? Let's see. Let me unmute you. All right, Mike, can you? I can hear you, or can I hear you?
I hope so. Can you hear me?
I can hear you. Okay, I was not sure what to say. Okay.
Great. Well, Stacy, first and foremost, thank you for allowing me the opportunity to be part of tonight's webinar, to be a guest speaker. You've shared some really powerful information, so far, and just really excited to talk to the audience, tell them more about different financing options, some of which you touched on slightly earlier, that I think we can take a little bit of a deeper dive into. And to the audience, I'm going to try to keep, things as basic as possible. But as we go, if you have any questions, please don't hesitate, to raise your hand. Feel free to ask questions as I move along. Save them for the end, whatever's preferred for you. Or if you wanted to just schedule time to talk about your individual situation offline, I'm happy to do that. And then my contact information will show a few more slides in. So to get started, want to talk about what is probably my personal favorite, helping individuals not only with homeownership, but those who aspire to develop a real estate portfolio over time. This can apply to someone who is just currently a renter, or it can also apply to someone who currently is a homeowner, depending on the type of property that you currently own. So if you're renting, you can use primary residence mortgages to acquire a home that you can live in for a period of a time. Call it 1 year, 3 years, however long that may be. We have financing options for single family homes that can allow you to put as little as 0% down. Some people may not opt for that. Some people may want to put a little bit more. 3% down is also another option. But there are programs that can allow you to acquire a one-family home that you'll be using as your personal residence with very little money out of pocket, especially with respect to down payment. And as Stacy mentioned earlier, also utilizing something known as a seller assist, where we can get the seller to pay a portion or sometimes all of your closing costs. Just to give you an example, using the conventional 100% financing program that we offer, that allows for a seller assist of up to 6% of the purchase price, which should be exactly, or if not a little over, what you need in terms of closing costs. And the program only requires a minimum of $1,000 out of pocket. So that can get you into a property where you can acquire an asset, start building equity, and then use it for leverage as time goes on. So pretty powerful if you're in a position where you're currently renting, or you do own a property, but it's smaller, and maybe you want to take another step up, but hang on to that property that you own right now and keep it as a rental. A great example would be something that Stacy mentioned earlier. Hey, let's say you own a one-bedroom condo currently, converting that over to an investment property when you move out, and then go using another primary residence loan to buy up for your next home, which is maybe a two-bedroom, one-bath. And then you live there for some time, and then you go do it again and use another primary residence loan, and maybe you buy a two-bedroom, two-bath, or a three-bedroom, one-and-a-half-bath. You can acquire a few different properties along the way using these low down payment options. And what's even better, primary residence loans carry much lower interest rates than when you get into buying properties that are strictly classified for investment use. Now, for some folks who are into multifamily properties, buying multifamily when you're a renter has definitely some great advantages. So there's conventional financings available for 2 to 4 family homes with as little as 5% down. There are some additional eligibility requirements, with the conventional financing option. Perhaps there could be an income limit. There are some restrictions, for that program type. But if you aspire to own multifamily properties because you want the additional cash flow, or maybe you have a concern about if you lose one tenant, what will happen with the rental income? Maybe you own a 3-unit and you have the other 2 units still be able to self-sustain that property. And then finally, FHA financing. So FHA financing allows really anyone who currently doesn't own a home, who's interested in buying a multifamily property. It doesn't matter if it's a single family or a 4-family home. You can buy a property with as little as 3.5% down. The requirements would be for this in the conventional option. You just have to occupy one of the units when they are a multifamily. But if you were to go for multifamily first, my recommendation is always go higher in units, right? Because from a mortgage underwriting standpoint, you always want to be able to show an underwriter that you're moving up, you're buying up in some way. So for example, maybe buying the 3-family FHA is the best first option, because when you're looking to acquire a few multifamily properties, going from a 3-family to a 2-family, where chances are you're going to increase your living space, is a lot easier for an underwriter to evaluate and say, you know what, this makes sense. It makes sense that they're going from a smaller unit and a 3-family property now to a duplex, a 2-family property where they're going to get some additional living space. And then you can use that strategy to maybe acquire, a couple triplexes or a couple duplexes, and then eventually settle into, the single family home, wherever you may want that to be. So some great opportunity for those that are renters or even currently owners. Really just depends on, how your vision is for what you want your real estate portfolio to look like. And for those that are owners currently, what your current resident situation is, and does it make sense to buy up and then go into something a little bit bigger. So something I can easily help you evaluate over a quick conversation. Next, if you do already own a home, you already own your single family residence, you're married, you have 2 children, the house that you own is just suitable for your primary residence, and you now have an interest in buying an investment property, well, now you're going to start to look at what the standard investment financing options are. Okay. So the most popular are going to be what's known as conforming programs. So you may have heard the names Fannie Mae and Freddie Mac before. Fannie Mae and Freddie Mac, they set the underwriting requirements that all banks and lenders have to follow to utilize their financing programs, which are always going to be your most cost-effective option. Okay. And the term conforming simply means everything about the loan application has to conform to what their underwriting guidelines require. So what you'll start to see is when you're looking to buy strictly investment, you already own a property, you own a single family, you want to buy a duplex, you're not going to be able to say, hey, I'm going to take my family of 4 and move into one of the units in the duplex and use a primary residence loan. It just wouldn't happen that way. So when you're in this situation, Fannie Mae, Freddie Mac, they are going to step up the down payment requirements because they will consider this property to be a greater risk to them. If something were to go wrong, if you were to have a hardship, and if one of your tenants were to move out, it's more likely someone would stop paying on an investment property than the primary residence that they need to keep the roof over their family's head. So that's part of the reason why you're going to see increased down payments, which for one family homes, they will allow for as little as 15% down. It does come with mortgage insurance because there is less than a 20% down payment. I'll be quite honest. It's not the most attractive option. It is better than other options that exist, but that would be considered, Fannie Mae or Freddie Mac's probably one of their highest risk lending programs. So they're going to account for that risk, in interest rate as well as mortgage insurance costs. Now, if you want to purchase a 2 to 4 family property, there is going to be a minimum down payment requirement of at least 25%. So that's where we can see that down payment requirement step up quite a bit. Fannie Mae allows, and Freddie Mac, I will say, they will allow for up to 10 financed properties. So what that means is properties that currently have a mortgage associated with them. So you can own 20 properties, but only have 4 of them financed. Well, that's okay. Fannie Mae will allow you to acquire another 6 financed properties and use their programs. And this is where you're going to see the better interest rates, the 30-year fixed loans, the loans that will really, help set you up for success for a long period of time, especially if you have a buy and hold strategy for your real estate portfolio. Now, one thing that they will impose are going to be loan limits. Now, if you're buying in the Philadelphia or greater Philadelphia area, these loan limits should accommodate, what you're looking for in terms of property costs. Sometimes they may not. If they don't, then we get into what's called jumbo lending. Things change drastically. It gets very hard to qualify for. So for the purposes of this call, we really want to focus on the majority of what you're going to see. So as you'll see there, question?
Is the 3 family a typo?
It is a typo. It should be 879. Good catch.
Okay. I have a typo. You have a typo. So I'll while I'm interrupting, there are handouts, so you can download the handouts of the slides, but I'm going to update it and send it out with the link for the recorded video later. So if you download it now, it'll have the 2 typos. I apologize. All right, back to you.
Great. Thanks, Stacy. Appreciate that. So credit score requirements. Fannie Mae, Freddie Mac, they will allow investment property purchases down to a 620 credit score. But what I will say is technology is very heavily utilized in the lending process today. Applications and credit reports have to go through their software programs. And oftentimes I find that credit scores below 680 start to get a little difficult to get their system to give us a eligibility recommendation. but I do tend to find that 680 and above certainly improves the chances for eligibility. So, keeping and maintaining your credit, something I'm going to touch on just a couple more slides in, certainly can help better position you to secure the best terms, should this be the type of financing that you need to use. Another good feature with Fannie Mae and Freddie Mac is they will allow first-time investors. So you could actually be a renter, believe it or not, and buy an investment property. That is something that only Fannie Mae and Freddie Mac will allow for. Other types of financing options, one of which I'll touch on next, will require some type of experience of being a landlord. But with Fannie Mae, Freddie Mac, there is no limitation placed on whether you're a first-time or a repeat or experienced investor. Now, lastly, and I think this is an important one to talk about, Fannie Mae, Freddie Mac, these conforming programs, they do require the deed to the property, which is the ownership instrument. The mortgage is just collateral. The mortgage is just security. The property is collateral. The deed is what truly owns the property. Many investors are attracted to putting the deed in an LLC because if there ever were an issue, let's just say there was a slip and fall issue, and there was a lawsuit, then the individual suing would not be able to pierce the corporate veil and get to the owners of the property personal assets because the LLC acts as a shield. It does shield the anyone trying to get to their personal assets through the corporation, but it doesn't always take care of everything. It is attractive. It is something that is highly utilized. Oftentimes, if someone's buying an investment property and they're not using financing, we will typically see the LLC being used, but there are some financing options that will allow for this. However, if we want the most affordable terms with Fannie Mae and Freddie Mac, we want to look to over-insure the property with excess liability coverage. Go ahead.
Yeah. So I bought all my properties in my own personal name, and I just got umbrella policies. So I insured myself to the hilt with each property, and then got an umbrella policy for $250 a year that puts my liability limits up to $1 million. So a lot of times people are attracted, like Mike said, to get the LLC because there is that inherent extra protection. Yet when it comes down to it and the bank requires you to personally sign for it anyway, and the rates are so much more attractive when you buy it personally, most of the clients that I work with, unless they're actually doing this as a business, most of them end up buying it in their personal names anyway. Then I recommend insuring yourself up to the hilt. So this is, insurance was our first of the 5 in the series. And then later in the series, in 4 weeks, we're going to have an attorney on, and we're going to talk more about LLC versus personal name. So I just wanted to pop that in there.
No, thanks for adding that, Stacy. That's a great point. Insurance, certainly is worth its weight in gold, to help with liability protection. Even with the LLC, if it's in place, the owner of the LLC is still the one showing up to court, paying attorney fees, potentially having to figure out a way to pay out claims. So it does protect personal assets, but insurance is certainly a huge component of making sure that your liability is protected, your assets can be protected, and really over-insuring yourself is a fantastic way to go. So. Okay, so I'm going to talk a little bit about some alternative financing options for investment properties. So these are going to be utilized if for some reason you may not qualify for the Fannie Mae, Freddie Mac conforming loans that I just talked about. Maybe you have more than 10 finance properties. Maybe you're self-employed and you don't show a lot of personal income on your tax return. Income is an important part of those conforming mortgages. Perhaps, you're looking at a 2-family property or 3-family property, which is going to require 25% down, but you only have enough to make a 20% down payment. Or simply, hey, you just want that deed in the LLC. Well, you have a couple options. You could look to do it with commercial financing, but you're oftentimes, going to see much shorter loan terms, like fixed for the first 10 years, amortized over the following 10. So your cash flow may not be as good. With these options, this will allow 30-year, potentially even 40-year loan terms that can help get you a better cash flow. If your personal tax returns or something that could affect your ability to qualify, it doesn't require any income. So these types of loan options will use a debt service coverage. So what that means is it takes it takes the total mortgage payment. So principal and interest, property taxes, homeowners insurance. There would be no PMI on these loans. That total monthly payment will then be compared to what the monthly gross rental income is. As long as the monthly gross rental income covers 100% of that mortgage payment, then it meets the debt service coverage requirement. So documentation such as tax returns, W-2s, pay stubs, even employment information is left entirely off the loan application. It's the property that is used to qualify for the mortgage. It also allows for a lower down payment if you do get into a 2 to 4 family. So previously we talked about Fannie Mae, Freddie Mac, 2 to 4 units, 25% down. Well, with this option, it's a minimum 20% down across the board. Doesn't matter if it's a single family or a quad. The minimum down payment is going to be 20%. And of course, terms will get better if you do wind up putting 25 or 30% down. Minimum credit score. So since they're relying more on property and less on income, we are going to see credit score requirement be a little higher. So Fannie Mae, Freddie Mac, you got that 620 minimum. Here, they're going to step it up a little bit, want your credit score to be at least a 660. Again, going back to, hey, maybe there's a reason I can't qualify for Fannie Mae, Freddie Mac financing because I have 10 finance properties or more. This program allows for unlimited finance properties. Doesn't matter if you have 10, if you have 100. And when we get into working with, when you become an experienced investor, at some point in time, if you do acquire a high number of properties, you're gonna cap out. You're gonna be stuck where 10 is going to be what you'll be able to get Fannie Mae, Freddie Mac. Then you're going to have to start looking into these alternative financing options, because as long as the property's cash flow, as long as that debt service coverage is met, they're not concerned with the amount of finance properties that you owe because they know the properties are self-sufficient. Also, loan sizes. Again, Fannie Mae did have those loan limits. They are pretty generous, especially when you get into, the 2 to 4 family options. But for example, if you run into a property and it just makes sense in every way, shape, and form to purchase it as an investment, and we're exceeding those loan limits, here we might turn to this alternative financing option to help secure the loan amount that you would need to acquire the property with. So unlike Fannie Mae, Freddie Mac, where I talked about you can be a first-time investor even if you just rent a property, with this particular option, you at least need to have home ownership. You don't necessarily need to have landlord experience, but you at least need to have owned a primary residence for at least 12 months. And then finally, something that a lot of investors they are very attracted to. This program will allow for the deeds to be held in an LLC. The LLC has to provide certain documents, has to be in good standing. Any member of the LLC also needs to be a borrower on the mortgage application. That's something important I want to point out. So if you're buying with a partner, but the partner can't qualify maybe because of their credit score, and you want to buy it in an LLC where the two of you own it together, unfortunately, that wouldn't be an option unless both people who own the LLC, or members, I should say, you can have multiple members, unless everyone can meet the qualifications for the loan program. Okay, another topic that is really popular amongst investors, again, whether you're just starting out, whether you're experienced, renovating, buying properties, fixing them up, sometimes refinancing them and then renting them out can really help build your real estate portfolio and help you grow wealth relatively quickly. What I like about renovation loans is you're buying properties that a lot of people aren't interested in for whatever reason. Maybe it's grandmom's house, still has the pink tile and the pink toilet and wallpaper everywhere. Maybe it's a complete shell, but the house is in the right neighborhood, it's in the right school district. It's in an area where the rental market is, just incredibly hot right now. These types of properties could be hidden gems because with your renovation options, you can acquire the home and build the cost of your renovations all into one loan. And there's a couple loan options that you can utilize depending on the number of units. But why I feel this helps you build wealth quickly is chances are you're probably going to get a good deal going in. You're buying a house that a lot of people aren't interested in. It's been on the market for 6 months, a year, possibly longer. The seller is looking to sell, but they don't have a very big buyer pool, maybe no buyer pool at all. Maybe it's simply because people are just looking for move-in ready. Well, that could be an opportunity for you to purchase a property, use a renovation loan to change just about anything with the property. You just need to leave at least one existing structural wall and bring the property completely back to life and build it out the way that that your vision allows you to set yourself up for success with that home. So for example, maybe it's a large one family, but you want to turn it into a two family. You could do that. You could turn a 4-family into a 1-family. There's really no restrictions on what you can do as long as it's within a residential zoning. Maybe you need a variance or something along those lines, but these renovation loans can allow you to modify these homes to set them up in a certain way to help grow wealth, but also help produce additional income. So the first option,
just a real quick tip. So
yep.
If you see a property that's a single family that's big enough, it should have RM1 zoning on it for you to more easily convert it into a multifamily. Multifamily
Right.
homes are a very small portion of the whole inventory of homes, like 1% or 6%, something really small. So don't set your heart on those, unicorns. And if something is a single, it's not easily converted, but look for RM1 zoning properties. And we have 2 minutes, and I want to
Okay.
wrap up. So yes, you want to finish your thought and just
Yeah, very quickly. So for the buy and hold investor, and if you're focused strictly on one-family properties, Fannie Mae has a renovation loan program where you can purchase and build in up to 85% of the after repair value. You're going to find your traditional 30-year fixed rate with this option. So if it's a one-family property, definitely something to consider. But Fannie Mae and Freddie Mac, they don't have renovation options for 2 to 4 family properties. So for that, we'd have to turn to the private money market. I have some recommendations. I'm sure Stacy does as well. But what you would look to use these loans for would be short-term use. Buy, renovate, and either refinance to keep it as a rental property if holding it is your objective, or you use it to fix and flip a property because it allows you to get in and out. It's a short close and then just typically a 1-year loan term with some different ways on down payment and after repair value to build in construction costs. So.
Cool. I love the way you explain things, Mike. Hopefully you guys got all that and feel comfortable to give us a call if you have any questions. We'll stay on a couple minutes after 8 in case you do have questions, want to raise your hand or want to talk privately, just let us know. I did want to just go through real quick the rest of the slides, just to let you know what's coming. So this is you'll have this in the handout, so you can get a quote from Mike about your refinance, your purchase, and then if a home equity line of credit seems right for you, rather than a cash out refi, you can call Univest or BB&T or your credit union for that HELOC. And Host for Hospitals, if you have a spare bedroom, Host for Hospitals is like Ronald McDonald House, where they're giving rooms for $20 per night to patients who are coming to Philly and using our hospitals, so patients and their families. So what could be a $1,400 stay is a $140 stay, because the generosity of people who have extra spare bedrooms in their homes are opening it up to host people visiting the hospitals. The series schedule, so in 2 weeks from tonight, we'll be doing processing a tenant and property management. So JG Real Estate, they've been my property managers for 4 years. They're amazing. They'll be our guest speaker for then. If you wanted to join us tomorrow at 2 o'clock, we've got a 30-hour session or 30-minute session. But in 2 weeks from today, 7 o'clock is the processing of tenant and property management. And let's see, here's a list of our guest speakers by date. And here is all of their contact information, so you can reach out to them. And lastly, here are 3 books that Gary Keller and friends have written about investing in real estate, buying properties and holding them, and flipping properties. So those are great resources that you can get through kellerinc.com. And so I will open it now. It's 8:01. I want to thank you for coming. I will update the PowerPoint slides and send that handout to you when I send you the audio by tomorrow. It'll also be on my YouTube channel, which is stacylovesrealestate.com. And of course, I'll just pause here, and if you have any questions, just feel free to raise your hand. I'll unmute you, and we'll be happy to chat. And thank you so much, Mike.
Thanks for having me, Stacy.
Absolutely. So do you mind holding on for just a minute to see if we have any
Of course.
brave souls question? Cool. Hey, Tiffany. Bye. Bye. Hey, Mark. Goodbye. Thanks for popping in, Roosevelt. All right. I think they're shy, and I trust that if you have any questions, you will reach out to us directly. All right. Thanks, Mike. I'm signing off.
Take care, everyone. Thanks, Stacy.
Bye-bye.